So let's take a step back and look at what's happening in the economy and the markets right now. Growth, as we just mentioned, is decent. Unemployment historically low, and stocks are near record levels. And yet, investors have been pouring money into so-called defensive sectors like utilities and consumer staples and real estate investment trusts. That typically happens when the market is going down. And it's something that our next guest says hasn't happened in decades. Jim Paulsen's back with us. He's chief investment strategist with the Leuthold Group. Jim, always good to see you. Thanks for joining us tonight.
You too, Bill.
What do you think the market's trying to tell us right now? Why are investors plowing into defensive issues when the market continues higher?
Well, I think that investors in general, you're getting a steady diet of things to be worried about. There's certainly a lot, Bill. We've got a reminder late last year how quick the market can fall. It had about almost a 20% decline. We're dealing with trade wars without end. We've got an inverted yield curve, which is a bad omen typically for future recessions. We've got to slow down the economy and earnings, which are flatlining. We've got geopolitical risk with Iran and maybe Russia. So there just seems like a lot to worry about. And they're taking that to heart. I just don't remember, to your point, being at a record high in the stock market with such concern about this market imminently going to fall. And as you said, the behaviors, it isn't even what they're saying, it's just the behaviors are all conservative and cautious. And I think, to me, that's a good thing for the market to move higher, because if things turn out not good, they just turn out better than feared, then I think the market could go up, and you've got a lot of portfolios underweighted, which means a lot of people would have to come in and start buying even more stocks, which could push it even higher.
All right, well, let me push you then for specifics. How far could it go up? Because right now you have strategists on Wall Street predicting the S&P will hit 2912, which is essentially where it is.
Yeah, that reflects that cautiousness I talked about, Contessa. Even Wall Street strategists feel that way. I think there's room for valuation improvement. We're trading at a trailing P price earnings multiple right now, which is just slightly above average from where it's been since 1990 in the last 30 years. And it's certainly much lower than it traded above 20 times earnings over much of 2017 and 2018. And you got to consider that interest rates, by and large, are a lot lower than they were then. We're now down to 2% treasuries.
Would you sell the
higher,
defensive stocks then right now?
I would. I would give those defensive stocks away to people that are really nervous at elevated prices, and I'd lean a little towards more aggressive investments. I'd look at the emerging markets, and I'd look at some of the things tied right to the trade war, the manufacturing sector, industrials and materials and energy stocks in particular.
All right.
And I'd also stick with technology in here.
Back to tech there. Jim Paulsen with Leuthold Group. Again, good to see you, Jim. Thanks for joining us tonight.
Thanks a lot.